Hello, everyone. Welcome to Tenet's Q3 earnings call. Thank you for taking the time today to attend this session. I'm Barry Ellison, Director of Marketing Communications here at Tenet, and we have Johnson Joseph, CEO, and Jean Landreville, CFO, who will take you through the results of the third quarter that were announced in our press release from yesterday. In our press release, we had asked anyone wishing to ask questions could do so by submitting them via email. And we did receive a lot of questions, and we thank you. And we will answer the most prominent ones during the Q&A portion of this call. Now, because of the abundance of questions submitted, we will not be addressing the questions posted live during this call, just for the sake of matter of time. Also note, all participants will be muted, and this earnings call is actually being recorded right now and will be made available shortly afterwards. Also, there's a handout section, and there's also a section with an icon called Slides, where you will find a reference document that you can consult during the review of the Q3 results. Just one last item before turning the session over to Johnson and Jean. As a disclosure statement, any discussion about future financial results and industry prospects should be considered forward-looking statements. Thank you, and now over to Johnson and Jean.
Okay, thanks, Barry. I'm going to give a brief introduction here on the results of operations for the third quarter, and then I will then pass it over to Jean, who is going to go over some of the financials, specifically comparing how we did this year to how we did in the third quarter of 2020. 2020. So, by all accounts, we're very pleased with the results of the third quarter of 2021. But I guess you wouldn't know it by the stock's performance today. We're still very excited about what took place in the third quarter. Perhaps the market misunderstood or has, I guess, like a different agenda than we do. But again, very, very excited with the results, beginning with the closing of the short form prospectus that we did, $52 million Canadian. That sets us up very, very well for pretty much everything we want to accomplish, not just in 2021, but certainly 2022 and possibly 2023. So we're on a growth path, and obviously it takes capital to grow. So we're very, very pleased to have been able to close this short form prospectus financing in the third quarter. Now, in terms of actual operations, we really looked at the third quarter as a setup quarter, a springboard, so to speak, to set us up for future growth. Now, I know that if you're an investor, if you've been invested in the company for the last year or the last couple of years, you'll realize that the end of 2020 and the beginning of 2021 were set up quarters for us, and we saw huge results from what took place particularly at the end of 2020. At the end of 2020, we saw those results in the second quarter. So there was a significant jump in revenue from the fourth quarter of 2020 and the first quarter of 2021 and the second quarter of 2021. Now, that would not have been possible without the investments that we made in the fourth quarter of 2020. And the third quarter of 2021 is essentially a similar quarter for us in terms of what we were able to accomplish. Now, during the quarter, we mentioned on several occasions, if you follow our news releases or monthly progress reports, we talked about 5 key verticals for the company. So one vertical is consumer goods. Then we have insurance. We have the steel industry. We have oil and gas, and we also identified clean tech. So those are the 5 verticals that we feel are the most important for us in order for the company to achieve the growth objectives that we set for the next couple of years. Now, we're already operational in the consumer goods section. By all accounts and from all accounts, we feel we've shown that we were able to be successful in the consumer goods sector. So our focus in the third quarter of 2021 was to make sure that we took steps to enter the other verticals that I just mentioned. So, for example, we in order for us to accomplish that, we acquired the Heartbeat Insurance Brokerage Platform, which gives us a foothold into the insurance industry. We launched the Link Steel steel trading platform. So that began slowly, but we expect activities to pick up considerably on the Link Steel platform, particularly in the fourth quarter of this year, and certainly even more in the first quarter of 2022. So we also touched on oil and gas as well. That happened near the end of the quarter, so we didn't mention too much about that in the MD&A this year because there weren't a lot of things to talk about. But certainly, oil and gas is also going to be a very interesting sector for us. And finally, clean tech. We have huge expectations for the clean tech industry. There's a lot of things going on right now at the government level in China that we feel we're very well placed to take advantage of. So this is a sector that our investors should look forward to in the coming quarters and years for us. Now, another very important thing, perhaps my point of view, is perhaps the most important thing that took place in the quarter was our agreement to acquire Kubler. Now, everything that we talked about that the company's been able to achieve so far has been achieved in China. Now, under the agreement that we had with Kubler, we were limited to operating in China. Don't get me wrong, China is a great market. It's got great potential, but we believe that the rest of the world gives us even greater potential. So this agreement that we were able to reach to acquire Kubler basically removes all of the hurdles, all of the barriers for us in order to grow our business outside of China. So we're extremely excited about that, and obviously we have plans to launch the platform either later on this year or early in 2022, and you're going to see more and more news coming from Canada, and eventually, certainly by the end of next year, you're going to start to see news coming from our activities to set up for the U.S. market. So for those reasons, we're extremely excited about what took place in the third quarter. Now, as I mentioned at the beginning of this short presentation, I personally could not be more excited about what took place in the third quarter. That was a very big quarter for us. It sets us up for pretty much everything I think we want to achieve going forward. So that being said, I'm going to pass it over to Jean, who's going to talk about some of the specific numbers related to what took place in the third quarter. Jean?
Thank you, Johnson, and welcome everybody to this meeting presentation. So I'm going to make an overall review of the Q3 2021 compared to the last year, same quarter of 2020. Like Johnson said, it's a transition quarter for us, very interesting. On the revenue side, the supply chain, the other business is quite stable, same profitability than the previous quarter, but the highlights for the revenue is the switch from the SSC business supply chain, more in the steel industry, to the consumer goods with ASST, and our introduction the oil and gas supply chain business with AGP. So it's a switch from, what is interesting here is that a switch from business that we own at 51% with the ASSC to business that we own at 100%, and it's $10 million more additional revenue compared to last year. So this is the first good news in the quarter. The second one is the cost of service. So is the cost related to these supply chain business. For the one who follow us for since a few months, a few years, the supply chain margin was quite low, and we're not too happy with that. So by switching to the ASST business and the AGP, we increase in the third quarter of 2021 by 10% the margin, which is a big improvement over last year. So, and that it's supposed the forecast call for that we're going to continue to add additional point of margin in the next quarter and next year. So that's very good. The transition mode that we're very happy with. Salary and financial. So the increase in salary, three things. Well, we increase the number of business, and we increase the number of headcount, especially in China and in Canada. Also, we're building a team here. Slowly in Canada, but in a fast pace in China. The increase in the share-based expense, which this is a non-cash expense, but as you know, the share price came up quite sharply, so there's an effect on the share-based expense that we calculated on as per the IFRS rules. And this is an expense higher of $420,000 over last year, and where some additional bonus provision compared to last year again of $200,000 with all the improvement that we made and the number of people that we add and the result that we have since the beginning of the year. Board remuneration, same thing. We have slightly increased the attendance fees for the board member. We add 2 board members since the third quarter of 2020, and the share-based portion also, which is mostly the big part of the remuneration for the board member, increase the expense. Again, this is not a cash out; it's an expense that we need to account it for as per the IFRS rules. Consulting fees this year we have a savings of $1 million, but if you remember last year we have the investment initiative in the second quarter and third quarter that we have some help from consultant that was paid mostly in share, and that was an expense of $1 million last year compared to $100,000 this year. So there's a variance of $1 million saving this year compared to last year, but it's a one-time item of last year that we don't have this year. Professional fees, other than legal fees, is following the increase in the business complexity, our introduction into the NASDAQ, the prospectus, and everything. So that increased the fees that we have from the professional fees. We also invest in investor relation and some marketing awareness in the market for $330,000 more compared to last year, and I think it was quite low last year, $88,000. So we're just coming back to a normal level of expense there. Finance costs, good news, we paid back all the debenture last year, so the financing costs, interest, and accretion is quite lower this year by $239,000. In China, there was some expense. We have two acquisition. One is the RB, the big one, and the other one is WeChain. We have an agreement with these companies that before we enter into the transaction that is signed up, we assume the cost. So that is a way of doing business that is, I think, is correct. But I cannot capitalize. I don't want to capitalize this kind of cost because it's really operational expense. So I pass that to the expense for the quarter. So that under $216,000. So one of the big item for this quarter is the gain on bargain purchase. So it's a little bit technical, but this is the Heartbeat software that we made the acquisition. We have a forecast that was prepared by the management in China. So I made the discounted rate quite conservative. The actual value of these cash flow forecasts that give me an amount of asset that I compare to what's going to be payable in now and in the future. So as per another actual rate, I have a difference between the asset that I acquired with the liability. So the difference was $1.9 million. Okay, so it's a conservative approach, which is going to be revised totally by the auditors in the fourth quarter, but quite comfortable that we're going to end up with that kind of a one-time item, which is, again, non-cash. It's IFRS rules, and it's going to reverse over the 2 years if all the assumptions get in place in the next 2 years. So it's a one-time item. So this is just that in the adjusted EBITDA for that amount. Amortization of intangible asset, same thing. The big item there is the RB acquisition in Q3, and we have also the fair value difference evaluation that we have to do on a quarterly basis. So the hard beat for this year was an expense of 171. Last year, the same exercise with Winnie, the acquisition that we made 3 years ago, was a gain of 217. So that's what a big variance of 389, but it's again non-cash, but IFRS rules are we accounting for the combination of companies. That's about it. So total expense, 7.3 million higher this year than last year, but revenue more by 10.5 million, 10.6 million for profit before income tax higher by 3.2 million. So income tax, just finish on that. It's strange that we're, making profit, but the income tax is quite high because in China, some divisions making profit. We're trying to make the tax planning the best that we can, but we still have tax, and the rate is 26% in China. So unfortunately, we have some tax that we try to reduce the maximum, but we cannot get rid of it. So we have a difference of 734 there for a net profit additional by 2.5 because we have a loss last year of 968, and this year we have a net profit of 1.5 million. So that's about my review of the Q3. We're gonna transfer that to Mark to answer some questions. Thank you.
Thanks, G. Yeah, to start out the Q&A for you guys, you can probably guess what the question is going to be. But number one, Johnson, can you talk a little bit about what's going on with the SEC review, Form F, any type of timeline you can provide to the extent possible?
Okay. So this is the question that everybody's been asking. It's about the NASDAQ listing. I get it. Listen, let me start off by saying that the United States is a country of the rule of law. Okay, so long as we follow the laws, everything will be okay. Now, as far as I know, I haven't read anywhere where it said that it was illegal for a company to do business in China. So let's get that right off the table here. There's nothing wrong with what's going on with the process with the SEC. We're following the rules. The SEC is not the boogeyman. They're not out to get us. They're very, very nice people. We've had some very cordial, nice exchanges with them. They tell us what to do. Basically, we comply with their rules, their guidance, and everything should be taken care of. So the last time I think we kind of touched on the subject was that we were asked by the SEC to submit a new 40F, taking into consideration the guidance that they provided for businesses who have a big part of their operations in China, which we have done. Now, the rule states that the SEC has 30 days from the time that the application has been submitted, the 40F has been submitted to them, for them to get back to us with comments. So we're still within that 30-day period, which expires, I believe, November 27th. Yeah. Okay. So November 27th is the date that people should be looking at. My expectation is that everything will go well. The 40F will become effective. Again, if there is anything that the SEC wants us to do, they will tell us, and we will simply do it. So they want additional disclosure, whatever. So we will get that information probably before the 30-day period is up, so that we have time basically to implement whatever they would want us to add in terms of disclosure or of risk factors or whatever. But then that's it. I mean, again, the SEC is not out to get us. They're nice people, and they're just doing their jobs. We're on the same page here. Okay, their goal is to make sure to protect investors by giving investors as much information as possible, and we're on board with that. So whatever disclosure they want us to add to the 40F, if there is, we will do it, and then the situation will be resolved, and then we will get back our NASDAQ listing. What people need to remember here is that we qualified for the NASDAQ. The NASDAQ has its own rules, right? They have guidance, they have requirements revenue, for this, for that, stock price, everything. We have met all of those requirements. So there are no issues here. I think a lot is being made of this issue. Investors, I understand if you don't know what's going on, like, you just see the stock has been delisted from the NASDAQ and you should be, you're concerned. I get that. But honestly, I don't think there's any reason to be concerned.
Oh, well said. Thanks, Johnson. Next question. Can you talk a bit about the sequential decline in revenue from Q2 or Q3 to Q2 or Q2 to Q3? Was that basically mostly because of the 618 shopping festival in Q2, or just can you dig into that? Maybe that question's for G too.
Listen, I'll take it. People seem to think. I guess by the way the market reacted, they seem to think that we're somehow caught off guard. That the Q3 revenues came short of expectations. They weren't. The Q3 revenues are exactly in line with what was expected. Now, and if you look at our guidance that we put out, I think for the year, for 2021, we're forecasting $109 million. And that forecast was revised, when was it? At some point during Q3, if I'm not mistaken, Jean, right, is when we put out the revised forecast. So obviously, if we're going to put out a forecast, okay, saying that we're going to make $109 million for the year, and we put that forecast out in Q3, knowing that things were already happening in Q3. So we already had a pretty good idea of what Q3 was going to be, and we still put out the forecast at $109 million. So that being said, we weren't caught off guard by Q3. So we maintain our forecast of 109 million, and very confident that we're going to make those numbers. Now, as far as the difference between Q2 and Q3, 618, that was the first time, right? We took part in 618, and it had a huge effect on our revenue. Okay, but that was all factored in when we put out our forecast. I think 618 contributed anywhere between 20 or 25% of the second quarter revenues. And in Q3, we did not have an event such as 618, but there is an event comparable to 618 taking place in the fourth quarter called Singles Day. So that took place a few days ago. We don't have the results yet, but that's an event that is as big, if not bigger, than 618. So I don't know how well we did right now in the Singles Day event. We'll get more information over the next few weeks or so. But the 618 event really, I'd say, is the main reason why there is a difference between Q2 and Q3.
Very good. And quick follow-up on that. So we're talking revenue right there, but in terms of 2021 expectations or guidance, does that include no change to net income, EBITDA as well? Like still on target for that?
Again, absolutely. Yeah, absolutely, Mark. Like, I mean, we put these, we put the revised forecast out, like, I think, I don't know, Mark, was it July or August, around that time frame? So obviously, like, I mean, we were well into Q3. So yeah, the forecast included the top EBITDA and the bottom line as well. So yeah, we stand by those numbers 100%.
Beautiful. Okay, good. Next question up. Given the extremely promising early results of the oil and gas related services with larger distributors, does the company expect the same level of interest in its services from these larger medium-sized distributors? And if so, is this vertical of the business currently past the early or pilot project phase?
Yes, first of all, I would say yes. We're past the pilot phase, and listen, when we create a subsidiary for a particular line of business, which we did for the oil and gas, it means that it's serious. We have high expectations for that vertical. So oil and gas is one of the 5 pillars that we've identified as growth pillars for the company. So yes, we're past that stage, and we do anticipate that that's going to be a huge contributor, well, a very significant contributor, revenue contributor for the company going forward.
very good. In terms of some of the different partnerships you've established, we're talking about ShopX and Grupo Coin. Can you elaborate or kind of dissect what kind of contribution they have to quarterly results, and then sort of project that, what you see from them moving forward and guidance for 2022 and so forth?
Sure. Although we haven't talked about ShopEX and the things that we're doing with Grupo Coin, it's not really Grupo Coin, but it's really more the influencers. That was something that was more in focus at the end of 2020. I mentioned earlier that some of the things that took place at the end of 2020 were springboards to revenue. So those things are really what's fueling transactions, helping JD.com retailers and distributors. So these are all consumer goods activities, right? So again, going back to the 5 pillars that we identified: consumer goods, insurance, oil and gas, clean tech, and steel industry, right? So right now, most of the revenue that's being generated by the company is being generated by the consumer goods sector. And that includes things that are happening with ShopEX, with the JD.com distributors, retailers, with the influencers. All of that is included in consumer goods and in the consumer goods vertical. So to answer the question, those activities are continuing to be the current base that we've set up includes things coming from ShopEX and from the influencers.
Okay, it's helpful. Regarding those verticals, could you kind of walk through, aside from consumer goods, which you would consider fully operational and contributing to the results?
Okay, again, consumer goods right now is the only one that is fully operational, like through the end of Q3. We started, right? A couple of them. We started the Link Steel. I don't know if you can say that insurance started, but there really hasn't. Jean, correct me if I'm wrong, but there has not really been any revenue generation yet from the insurance platform.
Very small.
Yeah. So that has not really kicked in yet. Link Steel, there was a little bit. It started, but again, it's negligible, right? From the steel industry in the third quarter. Okay. So really right now, Mark, the bulk of our revenue is still being generated by the consumer goods sector. So that's the only one I would say that is fully operational. The other ones are just getting started. And again, going back to what I was saying before, that's why we believe the third quarter was so important for us, because it allowed us to establish the steel industry, the insurance, which is going to be very, very big for us. The margins, everything related to the insurance platform are very, very interesting for us. And so insurance, steel, oil and gas, we just barely started. So I would say by the end of this year, Mark, to answer the question, we expect to have the consumer goods, the insurance fully operational, and Link Steel fully operational. Oil and gas, I would say maybe 25 to 50% by the end of this year. But that's something that we expect to really kick in the first quarter of next year, along with the clean tech sector. The clean tech sector, our objective is to get started this year, but not necessarily to have it be a significant revenue contributor before the end of this year. But certainly we should start to see some results from the clean tech in the first quarter of 2022.
Okay, that's helpful. This question might be for G. With the current cash balance, can you break down how much of that is residing in banks in North America versus overseas, China, basically? Can you give us a better idea of where the current balance is and how it can be tactically deployed for opportunities in North America?
Yeah, it's about, I was at this point about half and half. So I put the liquidity at 18 million, and we have around 10 million cash in Canada that we can transfer to China, obviously. And I was not saying cash, but cash available in China is $8 million Canadian.
Okay.
So we're in a very good position to, we're flexible at this point.
Okay. And then, so this also might be for you, a follow-up on not that, but a different topic. So for the Heartbeat insurance platform, so being that this was the largest acquisition for Tenet, is there any way you could present any 2021 or 2020 revenue or EBITDA updates for investors?
This is something that we do internally, Mark. We keep those internal those revenue forecasts per segment internally, and then we just present what the company expects on a, I guess, like on an aggregated scale. But just so you know, like, I mean, Jean mentioned that we had ran some forecasts or whatever and stuff on the hybrid platform. And we anticipate that platform will be a huge revenue generator for us, very, very significant revenue generator, and in terms of bottom line as well.
Okay, and then last question. Have you guys considered executing a normal course issuer bid?
Okay. Listen, Diana, is that you? No, I'm just no, this is like a bit of an inside joke. I'm sure if she sees the presentation, she'll know what I mean. So normal course issuer bid. Listen, for those who are not familiar with the concept, this is when a company basically takes its own cash and buys back its stock. So this is something that I guess like more mature companies do. To help with the share price. As far as we're concerned, Mark, we have better use of our cash right now. Like, I mean, we're in a growth stage, right? You know, so we need our cash to grow the business. So we're not too concerned right now with the short-term fluctuation of the stock price. To be honest with you, we're going to continue to execute our business plan. And you know what? If investors get it, they understand what we're doing, they buy the stock, then so be it. If they don't get it, you know, or they can't wait or whatever, we're not going to do anything out of the ordinary at this stage, basically to prop up or to bring up the stock price. There's really no need for us to do that at this point. We're going to continue to execute our plan and use our cash to grow the business.
Sounds good, Johnson. And that concludes our question and answer session. So at this time, I'll turn it back to Johnson for some closing remarks.
Okay, great. Thanks, Mark. Very, very nice questions. Listen, I don't know how many people we have on the line right now, but we always appreciate you taking the time to be with us. We appreciate the confidence that you've shown in the company. Hopefully, you see that the company's got a bright future, and you will hang on with us for the ride. We think the future is bright. We'd love to have you continue to be with us. So there's a lot to look forward to. So once again, thank you very much for your time, and see you next quarter, or perhaps we'll do something out of the ordinary and we'll have a presentation. Okay, so thanks again, everybody, and enjoy the rest of your day.